Recording in progress.
Good evening, students. Good evening to all of you. The students, today's class will be introducing students the term the head capital gains. Radha, very good evening. Kanaya, Namaskar, all of you, very good evening, students. So in today's class, students, we will introduce the head capital gains. And as I told you, students, that we also would be, like towards the end, we will also be solving the questions which is on the profit and gain from business and profession. And in that process, students, like for example, last lecture, students, we have done that particular, the 35 AD provision. So today, students, what we will do towards the end, we will be doing those 35 AD section as well, along with the, means through the practical questions. So that the application is through. And as I told you earlier also, students, we will have a consolidated approach of doing the solving of the question, the way generally it is, you are expected to know from your examination point of view. Now, on that note, students, the first is the capital gains, particular part. Now, as you all know, students, if you recall the scheme that we discussed so far as the head PGBP was concerned, in the head PGBP, students, we started with the chargeability. And then when we were discussing the chargeability, we came to know that the head PGBP has a base level, the threshold level, which is the net profit as per the books for business. And on that particular threshold amount, we are supposed to take the statutory adjustments. We are supposed to take what, students? The statutory adjustments or the ICDS 1 to ICDS 10 adjustment which are being there. Those are the adjustments that we are supposed to do. That will result into the profit and gains from business and profession. Obviously, students, there is a presumptive income provision also that will come into play. Again, I will be taking that particular part through a question, a case study basis, so that you know the presumptive provision. It's actually a simple particular part which all of you are aware from the interest C as well. So we will be discussing that particular concept as well. Under the head house property and under the head capital gains, or for that matter, under the head salary, students, we don't have the base value. I told you already earlier also. Do we have any base value on which we do any further adjustment? Answer is no. So there is no such base value on which there is a further adjustment has to be made. On the contrary, in these three heads of income, students, in these three heads of income, we are supposed to undertake the computation. What we are supposed to undertake? We are supposed to undertake the computation. And when we do the computation, students, it is not about the adjustment. In PGBP, we were doing adjustments, add and less. Those were the things that we were doing. And we will be practicing further on that. As far as the head capital gain is concerned, students, here you don't do the adjustment. Here you do, students, what? In this case, the full-fledged computation, which therefore will imply that there is a full value of consideration. If I'm talking about capital gains, and then thereafter will be reduced from certain amounts like expenses of transfer, then the cost of acquisition, cost of improvement, and finally you will get your capital gains. That is generally the format which all of you are aware of it, isn't it? So that would be the backdrop of the context that now we are entering into a particular head of income, which head, where we are not supposed to do the adjustment. What we are supposed to do? We are supposed to do the computation. Right from the first value till the last value, we need to know each and every element. What would be the value of this particular element, like full value of consideration? What should be the value attached? Expenses of transfer, so on and so forth. But students, the computation is a secondary step. The first step is that you will do the computation only when the income is chargeable under the head capital gains. So if the income is not chargeable under the head capital gains, the question of doing the computation will not arise. The question of doing the computation will not arise. Do you all agree to this one, students? Radha? Kanaya? Muskan? Unless and until there is a chargeability of the amount, attracted to that particular head of income. Can you proceed further to the computational particular provision? Answer is no. If the chargeability will fail, the computation cannot survive. If the chargeability will fail, the computational cannot survive. And as we proceed further, there is a landmark decision of the Supreme Court in B.C. Srinivasa Shetty, wherein you will also learn what? If the computation fails, the chargeability cannot be attracted. See the kind of the entire interplay between the chargeability and the computation. So what I told you initially, that if there is no chargeability of the amount in a particular head, then the question of computation will not arise. If there is no chargeability of the amount in a particular head, then the question of computation will not arise. Similarly, if the computation provision will fail, if the computation provision will fail, the chargeability cannot be attracted. These are the landmark principles, students, to open the discussion on the head capital gains. Do you want to take a note of this important principle, students, at the very outset? Perfect. I'll just dictate you. Just take a note of it, students, quickly. So, just take a note of it. I'll dictate it. Import. Please write. The computational provision will not be attracted unless the income is chargeable. The income is chargeable in a particular head. Income is chargeable in a particular head. Gayatri. Right, students, in the next line. Similarly, the computational provision, if the computation provision fails, similarly, if the computational provision fails, comma, the charging section will not materialize. The charging section will not materialize. Why, students? Students, this notes would be given to you in the portal. So that will be given to you in the portal now. Now, students, there are some very important amendments which have been made by the Finance Act 2026 in the head capital gains. You will realize as we will proceed further. And students, the style of the presentation will go the same, wherein the provisions, you will find the source and everything, primarily of the ICAI module, page number, everything has been mentioned in this regard. So those are being given students in this context. Now, students, just recall your inter-CA particular part, whatever you know about the old income tax law. Students, recall primarily the old income tax law in this case. if you can see over here in the context of the old income tax law, students, in this regard, in the context of the old income tax law, just recall whatever you know. The scheme remains the same here also. Obviously, there are some changes in the section numbers and all. That is fine, but the structure and the scheme remains the same. So, up till now, students, you have entered into the head PGBP. You are now entering into the head capital gains. The overall scheme of computation has remained the same, which will imply that finally the total income, which is charged under section number 4, the charging section, the overall chargeability on chargeability, the overall charge is on what? The overall charge is on the total income. And then how to compute the total income? That is what is unfolding now one by one. The curiosity of the students was whether under the new act, whether the computation has undergone the change. Primarily in that context, answer is no in this regard. So if you talk about the very new act, the computational per se has not gone the change. Whatever has been the change that has happened, those changes, important changes has happened in the old Income Tax Act 1961. I don't know whether you may be aware at this point of time, but let me tell you that students, you may be aware that under the head capital gains, one very important concept of indexation is out. Now we don't get the indexation, although there is an optional case where the indexation is still available that we will see. But these are what I'm trying to convey to all of you is that these changes has already happened in the old Income Tax Act 1961. This is more like a continuity which is happening in this regard. So we are in that continuity process in this context, and now we are now in the new law of the Income Tax Act 2025. So what is the scheme, students? Let's have a look. There are set of charging sections under the head capital gains. Just like the way we have got the chargeability under the head PGBP, like section 26, wherein the list of chargeability was there. If you can remember, the first one was on profit and gains, the general charge. And if you remember, students, then there was some specific charge. Gayatri, Kanaya, Radha, you would recall that specific charge. Say, for example, the compensation which was received on termination of business or business contract. Or may I say in that case, the value of benefit or perquisite arising from business, whether that benefit is in money or not. We have seen that Mahindra and Mahindra case got superseded, where now if you receive the benefit from business, whether it is in money or in kind, in both the cases, it is specifically charged under section 26. And there were some other particular list also, the chargeability that we have seen. Same now, students, will happen over here in the capital gains also. So we need to be very clear about what are the various situations of chargeability under this particular head that will be addressed by the charging section. Now, if you see over here, students, the structure of the chargeability, the general charge, students, that is there, section 61, subsection 1. And then there would be a list of subsections which are being there, and there are some specific charge which is there in those subsections, specific charge. Recall, students, in inter-CA, there was, if I can just give you one example of specific charge. In inter-CA, you may know under the head capital gains, conversion of a capital asset into a stock in trade. Conversion of capital asset into a stock in trade was considered as a transfer, and it was charged, isn't it? There was a charging section to that effect. So accordingly, those are the examples of the specific charging section that we are going to see. I'm just giving an example just to refresh your memory of something that you may know from your interest here. Okay, can anyone tell me right now, before I proceed further, in PGBP what you have learned on a similar particular ground? On a similar particular what I told you about right now, in PGP there was some item of similar kind of a chargeability which was there. What was that in PGBP that you discussed? Quickly, students. What was there in PGBP? Indeed, students. Very good. Excellent. So that, students, was about what? The stock in trade getting converted into a capital asset. The stock in trade, students, getting converted into a capital asset. Perfect. Very good. Excellent. So that is what exactly the point was. So as far as the head PGBP was concerned, we had seen a reverse case. And the reverse case was the stock in trade, students, was being converted into a capital asset. The stock in trade, students, was converted into a capital asset. Very good. After the chargeability, students, we will learn the computation. Now, students, recall the computation that you have dealt in your inter-CA. And the computation that you did in your inter-CA was in respect of one non-depreciable asset, like full value of consideration, less expenses of transfer, cost of acquisition, cost of improvement. Those were the cases of computation of capital gains, which is in respect of a non-depreciable asset. Then, students, there was a computation of capital gains for a depreciable asset. That was under section 50 of the old law. In the new law, students, you will find section 74. Can you see that? Non-depreciable asset 72, depreciable asset is under section 74. Fine. And students, then there is a slump sale also, which is under section 77. Slump sale under section 77. These are the main three. Now, students, there are list of provision which we'll talk about. That full value of consideration under this particular case will be this value. Full value of consideration under this particular case will be this value. This would be, students, there will be a lot of particular point that will be there in that context. So there will be a lot of valuation provision. Like, for example, if you can just recall simply, students, a real estate transaction. Remember, in the case of real estate transaction, there was a particular provision in your 1961 Act, 50C and all, which was an independent valuation provision in a real estate transaction, where we used to take the stamp duty value as the full value of consideration, something of that sort that you have learned. So there are independent, students, valuation provisions which are being there under this head. Thereafter, you will also find cost of acquisition, a lot of provisions which are related to cost of acquisition. Like, say, for example, students, if I can ask you, cost of acquisition for goodwill of a business being a self-generated asset, cost of acquisition being goodwill of a business being a self-generated asset, you will all say, student, that the answer is nil. Where you got this nil per se, students, this nil was nothing but where in that particular definition of cost in certain cases. So there were defined cost of acquisition that was there in this particular head. Those are the cost inputs. So there is a full value of consideration. In many provision, you will find FVC getting defined, so that you will, while you do the computation of capital gains, you will take only that FVC. Similarly, there are list of provision which will define as to what shall be the cost of acquisition in this particular case. So those cost only has to be adopted for the purpose of computation of capital gains. And thereafter, students, remember there were some 54 series exemption that we used to do in inter-CA under the old Act. You all used to do, students, 54 series exemption. Similarly, here also, students, can you see that exemptions and the deductions, students, is what you are going to take into account. 54 series, the way we have got like 54 series exemption, here also section numbering has changed. The principle in substance remains the same. And finally, students, once the exemption is done, if still there is a balance capital gains, then, student, this head, the beauty of this head is that this head has got some special rate of taxes. This head has got some special rate of taxes. And those are the special rate of taxes, students, which will be considered and dealt with it separately. And that exactly is the point, students. That exactly is the point. So this is all, students, the things has to be looked upon. I hope that all of you are clear with this one. So this is a structure that you always bear it in mind. Today's session, students, we will invest in that charging section. And you will come to know the general charge, how from general charge we have to find our way in the special chargeability. So therefore, one by one, we will take into account these particular schemes which are being there, and let's try to wrap it up in this particular way. Students, let's try to get into this particular part, students. Now, students, before I get into this one, please write section 67, subsection 1, the general charge. Let's start, students, with the very first section, and that section, students, happens to be the general charging section, students. Section 67.1. All of you in your notebook, please take a note of it. General charge. Section 67 of section 1. There you write gain arising from the transfer of the capital asset shall be chargeable in the previous year, in the tax year, no previous year now, in the tax year in which tax year, students? In which tax year the chargeability will be attracted? Indeed, in the tax year in which the transfer has taken place. Gain arising from the transfer. Gain arising from the transfer of the capital asset shall be chargeable in the tax year. In which tax year? The tax year in which the transfer has taken place. So be careful, students. Everything, I'll just take a note. I'll give you the notes on this one. Quickly, students, do one thing. Now we'll do one by one the things which are being there. So here, very systematically, students, just put across this observation. This is point number 1, gain. This is my point number 2, transfer. This is my, so I'll just do this as point number 2, capital asset. Point number 3, transfer. And then this all together would be point number 4. Please take a note of it. 1, 2, 3, and 4. From this only you will have to unfold your head capital gains. From this only, students, you will have to unfold your entire head capital gains. Have you all copied on this one, students? Just confirm this. Perfect. Students, I already have discussed this. I will just dictate it. You will also take a note of it. Please write for point number 1. For point number 1, write gain. Write in that the gain chargeable under this head is the computed gain under section students 72 to section 77. Under section 72 to section 77. Under section 72 to section 77. Okay. So the gain which has to be charged, students, is the computed gain. computed under which section? From section 72 till section 77. Whatever is the computational provision applicable, that you will apply. And once you have applied that, whatever is the gain that you have determined, that gain is what will be chargeable. In the PGBP, what was chargeable? Profit and gains. What is that profit and gains? The net profit as per the commercial accounting principle that we got it, the mandate from section 276. And then on that net profit, we did the adjustments. What adjustment? The statutory adjustments from section 22 to section, I think, 57. Those were the statutory adjustment that we did along with the adjustment as required under ICDS 1 to ICDS 10. Okay, so in a way we can say that PGBP, the profit is the adjusted accounting profit. Students, for PGBP, what we can say? Adjusted accounting profit. Whereas for capital gain, this gain is nothing but the computed gain, students. This gain is nothing but the computed gain. I hope that all of you are clear with this one. Isn't it? Now comes the next part, which is the capital asset, students. Now, is the capital asset defined? Yes, it is defined, students. I just want your attention, students, on the definition of capital asset, just a particular point, and I'll ask you a particular question over here. In this case, just have a look, students, the definition of capital asset. I'll just show you. Just a second. Many of you are aware of it. It excludes something like jewelry, personal effects, and all those stuff, isn't it? Certain things have been excluded. Rural agriculture land, those are there. Nothing has changed structurally, students. If you see, okay. So therefore, if you see the format as such, it means, and it does not include. It means primary, and then towards thereafter, students, it does not include. It does not include what? That is what they have been telling. Just read it out, students. Very quickly, you will read it once. Okay. Students, if you would have, all of you read, students, confirm once. Students, if you have noticed, students, capital asset definition, it means only point number A is a general point, whereas B and C is a specific. Similarly, when you read the term exclude, in exclusion, all 1 to 4 are specific exclusions. So there are two specific inclusion. Apart from what does it means, there are two specific inclusion in the definition, primarily, of capital asset. And when it tries to exclude, there are four specific exclusions. This is how students, first you should try to see how you try to decode it. When you learn, students, first try to learn the structure. Don't directly enter into the provision just mindlessly. You should always understand what exactly I'm getting into it. So the way I have highlighted, it means it does not include. Okay, so I know that there is a what it means, it will give me the meaning, and then there would be some exclusions that has to be given. Then when I read mean, what I know, the point number A which I read is a general particular principle based point, whereas B and C is a specific, what does it mean? A specific inclusion, I may say that way. That this is what the capital asset is. Then exclusions 1 to 4 are specific exclusions. I hope that all of you are clear with this. Now, friends, if you see over here also, in fact, personal effect, if you see here in this case, personal effect is excluded. That is true. Point number 2. But below that, further, if you see in this case, personal effect, not all the personal effect, students. In this case, personal effect, which is movable personal property. But at the same time, if you see here, however, jewelry and all will remain what? Will remain the capital asset. So in the personal effect, in the case of a movable personal effect, also, which is excluded from the definition of capital asset, there is some exception that look, these jewelry or archaeological collections, drawing, painting, sculpture, or any work of art, primarily, even if they are a movable personal effect, still we will consider them as a capital asset. Okay, so therefore, in a way, this, may I say that this is again a specific inclusion. Specific inclusion, students. So how do I remember this definition, important definition of capital asset? I will say that point number, capital asset definition, it means what? Point number A. Point number A, is it specific or general? It is general. Then there are 3 specific inclusions in the definition of capital asset. Which are those 3 specific inclusion? B, C, which is there that you are seeing right now on the slide. And then that movable personal effect, but what? Jewelry, archaeological collection, drawing, painting, sculpture, or any other work of art. These items, students, they being what? A movable personal effect, they still will be considered as a capital asset. I hope that the structure is clear to all of you. Once it is clear, friends, let's come to this one now. Students, this unit link insurance plan, primarily I will discuss that thing. In insurance, there is a separate segment we'll create on the insurance particular part. This particular thing, friends, this is, remember, any securities held by foreign institutional investors, which has been invested in such securities in accordance with the regulation made by the SEBI. Friends, be careful of FII. There were a lot of this thing. Whether the securities which are held by the FII, whether that will be considered as a stock in trade or it will be considered as capital asset. Before this provision was included in the definition of capital asset, there were a lot of litigation of that. For the reason being, please understand the frequency and the volume at which the foreign institutional investor used to participate in the capital markets, the frequency and the volume at which the FIIs used to participate in the capital market was such at a highest proportion, what was such, students, at a very high proportion, that assessing officer used to take a position that this is a stock in trade. And because it is a stock in trade, it used to go to the head PGBP. And FII used to say, no, it should not be a PGBP, it should be a capital, because our intention is investment. And accordingly, because our intention is investment, therefore, whatever is the gain that arise on the transfer, that should go under the capital gains. There were a lot of kind of, you can say, friction between the two. AO says no PGBP, FII says no, it is a AO. Huge litigation. And just imagine the consequence. Foreign institutional investors, now the moment it goes under the head PGBP, they will lose the special rate of tax. Because the profit and gains under the head PGBP, that is not charged to any special rate. The general rate will apply, applicable to the person, isn't it? Whereas this was the main litigation. Whereas here we have concessional rate of tax, primarily, which is there at say 12.5% and all. So that was one of the major litigation, and the government, in order to put an end, the government, in order to put an end to this litigation, they have made a specific inclusion now by putting point number B. Now, as per point number B, students, you can see any securities which are held by FII would be considered as what? A capital asset. So, all the litigation put to rest, students? All the litigation put to rest? Answer is yes. That's exactly what this point number B is all about. See, I have already told you unit link insurance policy that we will see as and when it will arrive. It does not include students, this and that, all the things are being there. Students, just one particular part. Here comes the entire case. You will find the main analysis, students, is this part only. The main analysis, students, is only on this part. Okay. Now here, students, be careful. They are saying property of any kind held by an SSC, whether or not connected to his business or profession. Property of any kind held by an SSC. That is it. Whether it is a business asset or a non-business asset, we don't care. But property of any kind held by the SSC. What do you mean? So ultimately, the entire capital gains chapter hinges upon on this concept, which is the concept property. And what you mean by the term property? There are plethora of judgment. There are, students, many judgment primarily which has been there, and as one landmark judgment, which is the Vodafone case, Supreme Court, everyone is very clear. Property means, students, nothing but just right, legal exclusive right. When I say the term capital asset, students, this is a very wide phrase. This is a very wide phrase, students. They are using the term, not the asset. Capital asset is the name or the terminology, but the definition opens up with the term property. And the term property is much wider term as compared to the term asset. What does the term property means? Legal exclusive right. So it is not confined to something which is a tangible asset. Anything which is an exclusive right available to me. Anything, students, which is an exclusive right which is available to me, that is what will constitute a property. I give you an example, students. Maybe if you would have done it in the inter-CA, you can recall and you can appreciate this concept straight away. Or before that, students, in this case, before that, before giving you that specific example, let me put you on test at the very outset. Let me see probably how many of you do remember or could correlate in that way. Students, if you remember in your inter-CA section 54 was there. Exemption was in respect of what? You are transferring a long-term capital asset, being a residential house property. A house property, may I say that way? And whatever is the consideration that you have received, you are investing the consideration or reinvesting the consideration in acquiring another house property. In a simple language, I'm just trying to put across the things or facts before you. So you transfer a house property and the sale consideration you are purchasing to buy another house property. Okay, perfect. Now let me put you a question. If you all are ready, with your permission, students, are you ready? Then let me ask you the question. Everyone. Perfect. Kani, Radha, Gayatri. Here, students, the question is, there was an SSC. Be careful, students. There was an SSC who has sold his house property. SSC has sold his house property. Okay. Now he got the sale proceed from the house property. And what he did about that sale proceed, students, from that house property, he used that sale proceed to acquire students 50% of his brother's right in another house property. Again, I'm repeating. I had a house property in Mumbai. I sold that house property in Mumbai, and whatever were the sale proceed, I used that sale proceed to acquire 50% of my brother's right in another house property, say in Chennai. In that house property in Chennai, I was 50%, my brother was 50%. So I sold my Mumbai house property. The sale consideration I used to purchase my brother's another 50% right in that. Question therefore to all of you is whether the sale that I did of Mumbai house property on which I got the capital gains, will I be eligible for the exemption? Which exemption? At 54 old section. Now the new section will quote, but just to test you the concept. Will I be eligible for exemption in that 54 section? Old 54 section in this particular case. I sold my Mumbai house property. Sale consideration I used to purchase my brother's 50%, the share that he had in Chennai house property. So will I be eligible for the long-term capital gain exemption on the transfer of Mumbai house property? Did I satisfy the condition of section 54 of the old act? Quickly, students. Let's see. And please also do give me the reasons as well, if it is possible. If it is possible, do give me the reasons also. Let's see. Students, I request that if possible, those who are there from the portal, students, please do join here so that all the notes and all, primarily you can just take through those who are joining through the portal, they can take the notes also. In the live class, you would be in a position to also ask the queries as well. Okay. Okay. Gayatri. Okay. Radha. Kanaya, what's your take? Yes, Gayatri. So students, be careful. What I told you, students, what is the requirement of section 54? You sell the house property and the sale consideration you use for what? To buy another house property. To buy what? Another house property is a requirement. And what did I told you just now about the term property? The term property means a exclusive right. Now, please tell me, in that Chennai house property, did my brother had an exclusive right to the extent of 50%? Did my brother had an exclusive right? Did he have a legal exclusive right to the extent of 50%? And the answer is yes. He is an exclusive owner to the extent of 50%, rather. He is an exclusive owner. I can I encroach that entire property in my name? Can I do it? I can sell the entire property. Can I do that thing? That would be something a void transfer because he continues to remain for that 50% share. That is his legal exclusive right. Exclusive does not imply rather in that case 100%. Exclusive students in this particular context would mean whatever share I am holding, that much to the exclusion of the others. Remember that. PGBP also ownership, I taught you that. So therefore, that much share which I am having, that much is exclusively assigned to me in that property. So what I did, I sold my Mumbai house property, consideration what I received, I acquired my brother's property. What is it property? That 50% right that he had in that Chennai house property. And on that note, students, will I be eligible for the exemption? And the answer is yes, because I have purchased another house property. Property is the word, students. This is what was being held by the Supreme Court in T. Arvinda Reddy landmark judgment. And that tells you the significance of the term property. Property means legal exclusive right. Now I will give you a simple example. I just want to tease you through this particular case law of the Supreme Court in T. Arvinda Reddy. Now, friends, just recall in your interest here. Friends, in your interest here, you people would have done one particular point And that is about, if you can recall, remember students, right entitlement, but 50% property. 50% property, I'm the brother in this case. My brother, 50% he is holding. So 50% I am holding. 50% I am holding, 50% my brother is holding. So what I did was that I purchased his 50%, the exclusive right that he had in that particular property to the extent of 50%. The extent could be something, that is fine. But did he, whatever extent that he had, to that extent, did he had an exclusive right? Answer is yes. Whatever thing, what is the exclusive right that he has got? Say, for example, if rent is coming to the, if tomorrow, if the property earns rent, does he have an exclusive right to receive 50%? Yes, he has the exclusive right to receive 50%. Tomorrow, if the property is sold, say for example, if it is sold, does he have the right to get the 50% share? And the answer is yes. These are his exclusive right in this case. So what I did was that I have sold my Mumbai house property, and then I purchase his 50% share. By purchasing his 50% share, I have purchased a property. Which property? A house property. And that is what? By purchasing the co-owner share. Purchasing what? The co-owner share. Primarily, I have acquired his property, and accordingly, I have acquired a capital asset being a residential house property and therefore eligible for exemption under section 54. I hope that this point is well taken by you. Now, I give you students one more example. Remember that particular case, students, if you can recall, a company, students, a company, I am a shareholder of a company. Students, I am a shareholder of a company. Kanaya, I am not able to log into Zoom via my laptop. Please look into it. uh, I think the technical team will just give you some message. Okay. Okay. Be there, Kanaya, anyways. Like, listen to this carefully. I think you'll get through it. And if there are doubts, so maybe by today end session or maybe in the next class, you can ask me. No, don't worry. Just listen to it very carefully. Now, I give you one more example. Students, be careful. One more example. Remember, students, I am a shareholder of a company. And in that particular company, students, I am having a right entitlement. Remember, existing shareholder gets the right entitlement as per the company law. If you are an existing shareholder, do you have a right entitlement to acquire the shares of the company if the company goes for a fresh issue? Tell me that, students. Do the existing shareholder have a right entitlement to acquire the shares of the company when the company goes for a fresh issue? Answer is yes. The existing shareholder has the right entitlement. They will have the first right, and then only the company will go to the outsiders, isn't it? That is what it is at the end of the day. Now, I am the shareholder of the company. I got the right entitlement, but I am not in a way happy. I don't want to subscribe. Friends, I don't want to take the fresh issue. What I am doing, friends, what I am doing is I am selling the right entitlement to you. You are very bullish on that company. You think that this company will grow. So what I did, I transferred my right entitlement to you. I transferred my right entitlement to you. Question therefore to all of you is whether this transfer of right entitlement, students, will it be charged as a will it be charged to capital gains? Or may I reframe the question? Did I transfer a capital asset in this case? What I transferred was not the shares. What I transferred was not a shares. What I transferred was a right entitlement. So therefore, the question to all of you is that whether the transfer of a right entitlement will it result into a transfer of a capital asset? Answer is yes. Remember, you people did something in inter-CA, in that you are doing the computation of right entitlement. Why it is chargeable to capital gains? Because what I transfer is a capital asset. And what is this capital asset, friends? The legal exclusive right. What is the exclusive right? The exclusive right that I have is that being a shareholder of the company, I would be given the first particular preference to acquire the shares. That is the right entitlement. Is it an exclusive right to the existing shareholder? Is it an exclusive right to the existing shareholder? Answer is yes. Though we are like a co-owners, all the shareholders are like a co-owners, but it's an exclusive right to all of us, to the proportion in which we hold the shares. And if we don't exercise our right to acquire the share, instead we transfer this right outside to other person, then what we are transferring is nothing but a capital asset. Why? Capital asset means property of any kind. Is this, what does this property in this case? What is this legal exclusive right in this case? The property in this case, students, is the right entitlement. Rights. Perfect. This would be indeed, students. So that exactly what the term property means. So this is what, students, even the main case law, students, if you see these kind of case laws, you should be very clear for us. So the Supreme Court level judgments are basically on this definition of capital assets and all, definition of transfer. Like that, the judgments are there. So this is something, a particular heads of income wherein we need to be conceptually be very clear. The earlier head of income, students, you have to be computationally be very clear. So therefore, we need to keep solving the questions that, as I have told you, that we'll keep on doing it, students, till the time we are very much comfortable and we are perfect in the head PGBP along with the total income part. That I'm going to get on with all of you. Shall we proceed, students, now? Now, students, in this context, let's proceed further. So, students, let's take the things further in this discussion. So, herein, if you see, so this is the definition of capital asset. Now, students, just just write with a bit of note. If you can just write small note, and then we proceed to our next particular part. The definition of capital asset. Please write a note. The definition of a capital asset of the term capital asset is very wide. Is very wide. Full stop. It means property of any kind. Students, it means property of any kind held by the SSE. Held by the SSE. Underline the word property. The term property, the term property the term property means the term property means a legal exclusive right. The term property means legal exclusive right. Full stop. Students, just a very simple example, a layman example. I have students sold, say, you buy newspapers. There is a accumulation of newspapers at your home, and then what you do at the end of month, You dispose of those newspaper. You dispose of the newspaper, isn't it? So tell me one thing. What you disposed was your property in this case. The newspaper, finally, what you disposed, was it your property in this case? Answer is yes, students. Do you have a legal exclusive right on that particular newspaper that you purchased? Do you have a legal exclusive right on that newspaper that you purchased? Answer is yes. So therefore, is it a property? Answer is yes. You have a legal exclusive right on the newspaper that you purchased. Is it therefore a capital asset? If it is a property, is it therefore a capital asset? Answer is no. Why? Capital asset exclude movable personal effect. Capital asset exclude movable personal effect. So therefore, is this newspaper that you get for your home, is it a property? Yes. Is it a capital asset? No. Why? It excludes. Exclude what? Movable personal effect. So it will go under that particular exclusion. Is stock in trade your property? Is stock in trade your property? Can I say so? Is stock in trade your property? Answer is yes. Stock in trade is very much your property. Is it a capital asset? Answer is no. Why? Because of the exclusion. This is, you have to be very careful when you write your answer, students. Be very legally precise in this particular thing. I hope that all of you are clear with this one. Now, students, the concept of students, capital asset should not, we cannot move further unless and until, students, we settle down primarily whether, once we know that the property is in the nature of a capital asset, once we know that the property is in the nature of capital asset, we just can't move to the next definition unless and until, students, we characterize the capital asset either as short term or long term. We need to know, students, whether that particular capital asset which is concluded as per the definition, whether that capital asset, can that be considered as a short term capital asset or a long term capital asset. Now if you see over here, the definition has been given. Now we have this threshold of 12 and 24 months, as the case may be. Just have a look, students, to what is for 12 and what is for 24. Period of holding. Period of holding, students. So 12 months and 24 months, friends. 12 months is in respect of securities. The threshold of 12 months is for the security. Which security, students? Listed on a recognized stock exchange in India, and then they further extends to the unit of UTI, unit of equity oriented funds, and the zero coupon bond. These are the securities primarily which will be considered as a short term or a long term depending upon their period of holding. What about the other capital asset, students? So far as the other capital asset is concerned, for them, students, the threshold is 24 months. Primarily. For all the remaining other capital assets, the threshold is 24 months. Students, there are certain exclusions which are being given over here. This exclusion, students, we will discuss it as and when the time will arrive. Right now, it is premature to even look into this particular this thing. What period is excluded? What period is included? So, in the period of holding, students, like for example, right now still it is immature. Premature, I will say. So, premature, I will not continue that, but many things you are aware of it. Many things, students, are you are aware of it. Let me frame those case examples at appropriate time, and then I will tell you this is what you are learning at that stage. Okay, so not right now, but once in the appropriate time. So students, now we have settled down with the concept of capital asset. What do you mean by the term capital asset? It means it excludes. Further, once a property is settled as a capital asset, we have to further investigate to find whether that as capital asset, is it short term or long term? Because the rate of tax differs. The rate of tax and the treatment differs in that context, isn't it? Like then if it is a long term capital loss, subsequently you will realize the long-term capital loss can only be set off against the long-term capital gains. So it's not only about the rate, but also about the treatment that will differ. So therefore, it becomes of high importance that we need to know about the same. So students, come back to the charging section students again. Gain arising from the transfer of a capital asset. Now comes the definition of students transfer. Now comes students the definition of transfer. So if you see the general charging section again, 67.1, gain arising from the transfer of a capital asset will be chargeable in the tax year in which the transfer has taken place. Will be chargeable in the tax year in which the transfer has taken place. So transfer becomes a very particular important part students over here. Again, I will invite all of you just very quickly read this point from A to G. All of you. Now, just read it once. This will come heavily in our explanation now, subsequently. But I just want you to be familiar. Just be familiar with this definition. A familiarity level is fine. We will investigate this definition after some time. But just be familiar with this particular definition of transfer. Okay? Students, it is not the transfer that is important over here. So I think all of you have read this definition. In this case, these things will be investigated, students, one by one. But just for the time being, it is no longer important. It's not only important that there has to be a transfer within the meaning of section 2 clause 109. Once we know that this is a transfer, we have to also see whether such transfer is also in the nature of a taxable transfer. Such transfer, is it also in the nature of taxable transfer or not? If it is not in the nature of taxable transfer, students, then the chargeability will not be attracted. Then what will not be attracted? The chargeability under section 67 that we are discussing right now will not be attracted. You would say, sir, what is this taxable transfer? You know, students, just that the section number is now different. So you are wondering. Let me take you back, students, in this case. If you can recall, students, of your interest here, father to son, say through gift, will, inheritance, succession, the asset was being received, or the father may have transferred the asset to his son, say through a gift. Is that a transfer? Yes, it is a transfer. Why? Because in this case, it is more like a relinquishment of right by virtue of, say, gift, or by virtue of, say, a will. I am relinquishing my right in that particular asset in the favor of my son or my relative, as the case may be. So, is it in the nature of transfer? Answer is yes. But you know that under old section 47, new section 70, it is not to be considered as a taxable transfer. It is not to be considered as what? A taxable transfer. Is that point clear to all of you students? Every one of you. So now, students, when you do your final CA in this particular context, you should all be, in fact, students, you should all be ready and be very capable to deal with this set of section students, section 70. There is a list of section 70 students that has been there, and you all are aware of it. Many of the list you are aware of it. Many of the list would be very new for you. That is fine, that we will see through it. but many of the things you are aware of it. One example I already gave you, father to son. The asset is received through a gift, will, inheritance, or succession, whatever be the mode. In such case, in the hands of the father, it is not taxable. Why? It is covered in that list of section 70, not a taxable transfer. Is that point clear to all of you students? All of you, just confirm on students before you proceed. So it is not only the transfer that has to be seen. It is not only the transfer that has to be seen. What also needs to be established that whether the transfer is it falling in that list of section 70. If the answer is yes, not a taxable transfer, therefore it is not chargeable. If it is not falling the list, if it is not falling in the list of section 70, then it is a taxable transfer. Chargeability will be attracted. I hope that all of you are clear with this, students. Up till now, every one of you. If that is the case, students, we'll proceed to our last segment in this context. Everyone, any queries, students, up till now? Quickly ask me if you have any queries, students. Use a voice if it is possible, or else confirm no query.
Sir, am
Please.
I audible?
Yeah, audible.
Yeah, sir, sir, you said father and son, the relative contact should be there. But if, for example, a nurse was treating a person who is a very old man and he's
Rather, we'll
about to
see
die,
that and reserve this particular this thing when we do section 70. At that point of time, now, who all are
okay,
covered? All that specific we'll discuss in 70. Right now, I'm not covering
okay,
70. But yes,
okay,
the what are there in 70? Like a close-end transaction or any transaction that we will see. The
yes,
query is that sir, any gift, any particular will, or only gift or will to relative is
correct,
covered. That specific particular part we will see when we hit that section 70, which is there a part of it now. So it is there.
okay, sir,
Okay. But the structure, what I'm trying to frame right now is about the four corner structure of this particular chapter, because this is how you should think. The thought, channelizing the thought in the proper way in this particular chapter is such a critical thing. Okay. So that you know that, okay, this transfer I qualified, but is it a taxable transfer? If the answer is yes, then fine. I am going to go ahead and do the chargeability. If it is not a taxable transfer, which means it is covered in that list of exemption, then it is not a taxable transfer. It means chargeability will not be attracted. So just try to, students, hold to the principle, which is very important. And now once you are done with the principle, I will now start hitting the specifics. We'll come one by one. But before I come one by one, what was the last particular thing in section 67 subsection 1? The general charge, students. Let's again take back. Gain on transfer of capital asset shall be chargeable in the tax year. Which tax year, students? In the tax year in which the transfer take place. In the tax year in which the transfer take place, students, isn't it? So this is what will be the chargeability. This is what is the general chargeability. So please just write one note now. Note number 4, I suppose. I think that was point number 4. The general charge. Point number 4, students, please write. The general charge under section 67 subsection 1. Under section 67 subsection 1 is attracted. The general charge under section 67 subsection 1 is attracted in the tax year. In the tax year in which. In the tax year in which the transfer has taken place. The transfer has taken place. Full stop. Now, students, be careful. Be careful, students. You will find that there are some list of cases. Be careful, students. There are some list of cases where what? Where even if the transfer has taken place in the current tax year, the chargeability is not attracted in the current tax year, but they are postponed or they are deferred for the subsequent year. What therefore we will do? So in the general charge, it says what? That the chargeability would be attracted. So in the general charge, what it says, the chargeability is attracted in the tax year in which the transfer take place. But there are some provision, specific provision, which says that no, in this particular case, the chargeability will not be in the tax year in which the transfer has taken place, but the chargeability would be postponed in some other years. Which are those cases? Now just have a look, friends. If you see in this context, see point number D over here. Point number D, conversion of a capital asset into a stock and trade, students. Conversion of capital asset into a stock and trade is considered as a transfer. So as per the general charge, what is the tax year in which, what is the tax year, students, in which the chargeability should be attracted? So as you can see, students, the tax year in which the chargeability should be attracted is the year in which the conversion has taken place. The year in which the conversion has taken place. Do you all agree? That is the year of transfer. But we know, if you can recall your old provision, students, in that you have learned that it is not charged in the year of conversion, but it is charged in the year in which the stock in trade is actually sold. So can I therefore say it is an exception to that rule? Which rule? The rule of the year of charge is year of transfer. So just write now in the next line. However, there are there are certain specific charging section. However, there are certain specific charging section where the year of charge is not the year of charge is not the year of transfer. The year of charge is not the year of transfer. The year of charge is not the year of transfer. Right? Point number one. Conversion of capital asset into stock and trade. Section 67, subsection 6. Section 67, subsection 6. Right in this, students, below that, in the same point, in section 67, subsection 6, please write. Though the conversion of capital asset into stock and trade, though the conversion of the capital asset into stock and trade is a transfer, is covered in the definition of transfer, is covered in the definition of transfer, is covered in the definition of transfer, but the chargeability is not in the year of conversion, is not in the year of conversion, but in the year in which the stock in trade is sold. The stock in trade is sold. Firuz, I think this thing you would have done in your inter CA also. So we'll just, and this, you don't get any independent question. Yes, in your question number 1, they will target it over here. Because here there are two particular case students. One is a case on capital gains, another is a case of PGBP. Supposing students, you have taken the land, and this primary, let's say the cost was say 10 crores or 100 crores. Now, what has happened? This was say in year number 1, in tax year 1, whatever, tax year 1. Now, say in tax year, in this case, herein, the land was converted into stock and trade. I'm just using the abbreviation SIT, stock and trade, primary, in year 4. The land is converted into stock and trade in year number 4. Or just let me start testing you this. In year number 2, the next year. And at that point of time, the fair market value was rupees, say, 175 crores. Okay. Then the land now, which is a stock and trade, was sold. This happened in year number 4. And that was being sold at, say, 300 crore. Okay. These are the years which are being there. These are the year students that has to be considered. Now, students, you yourself tell me, obviously, you should be in a position to answer this. How much is the capital gains and how much is the, I'll ask you two questions. How much is the capital gains and how much is the business income? Let me start asking you the question, and on that only I'll know how much point is clear to you, and accordingly we will be how much point on the principal base. Now I'm asking the question. In this facts, tell me how much is the capital gains and how much is the business income? Quickly. Say students, how much is the capital gains and how much is the business income? Kanaya, capital gains and business income? Gayatri. Radha, I think you meant 125 for capital gains, isn't it? Let's see. In this context, students, Okay. So students, over here, be careful, all of you. Over here, students, if you see this one very carefully, what exactly you all get? Please have a look, every one of you. Students, in this particular context, yes, yes, yes. Now, this, can I say, students, now this, I think all of you have taken the note. This is the year of transfer. Is this a year of transfer? Answer is yes. By the way, what is this clause? I just need the clause, students, because this will be used at multiple places. So why don't you remember this clause itself? So I just need the clause number for the same, so you can remember that also going forward. Few clauses, whichever you all can remember it, do remember it. 109. Students, 109. So is it a transfer, students, under section 2 clause 109? Answer is yes, it is. It is indeed a transfer, students, under section 2 clause 109. That is established. That is established, students. It is a transfer under section 2 clause 109. This is all established in this case. If it is a transfer, students, whether the year, the chargeability under section 67(1), the general charge, this is known as the general charge. Whether the general charge under section 67(1), is it attracted? No. Why? The chargeability is attracted in the year of the transfer of stock in trade, which is in year 4. So, by virtue of a specific charge, what happens? The charge under section 67(6), the charge is under section 67(6). This is a year of charge. Year number 4, students, has become the year of charge. Is that point clear to all of you? This is what this has done. And what is year 4? Explain me, students, what is year 4? Year 4 is the year in which the stock is sold. This is the year of stock. Year of stock sale. Year of stock sale. I hope that all of you are clear with this one. Now, in this very year itself, you are going to do the computation, students. In this very year, are you going to do the computation? Yes, you are going to do the computation this very year itself. So, students, if you see very, very carefully, so the computation will happen here. Now, students, here the computation, or may I say the charge, because the chargeability is attracted here. So, is it possible? Now, this is a very important principle. Is it possible that the chargeability gets attracted in year 1 and computation you do in year 2? Is it possible? Answer is no. If the charge is getting attracted, this is the general principle. Huh? If the charge is getting attracted, say in year 1, then the computation also has to happen in year 1. Primary. It has to go hand in hand. It cannot happen that one is preceding other. That will never happen. So therefore, this becomes the year of competition. So competition in which year? Year number 4. Of what? Of capital gains. Of two things here. One is of the capital gains. Up till here, students, fine. See the method, students, of arriving at the answer. That is very important. The approach. Your line of thinking has to be very clear. The line of your thinking has to be very clear about this one. How you are approaching this particular part. Now, if you see in this context very carefully, what I get in this context, students, is that this I compare with this thing. Can you see that? Because up till year number two, it was a capital asset. Up to year number two, it was a capital asset. After year number two, it ceased to remain a capital asset and it became a stock in trade. And did in the year number two the transfer took place? Yes, the transfer took place in year number two. Was the mode of transfer? That mode of transfer was through conversion. But the transfer took place in year number two. And when the transfer took place in year number two, what was the fair market value that was prevailing at that point of time? The fair market value that was prevailing at that point of time was 175. The fair market value that was prevailing at that point of time is 175. So at the time of transfer, here it was at the time of transfer, students, the FMB which was prevailing, FMB under which that was prevailing was that particular 175. So now can I say, students, this is the valuation provision I'm getting? If I'm taking the, students, just hold on, just hold on, just hold on. I'll write it below. So capital gains I'm computing. What is the first thing I require? Now capital gains I'm computing, students. What is the first thing I require? Capital gains computation, the first thing I require is the full value of consideration, FVC. I'm just using the abbreviation, but this is nothing but the full value of consideration. So full value of consideration. Now full value of consideration over here is nothing but the fair market value. The FMB, students, in this case, on the date of transfer. On the date of transfer. So the FMB, students, on the date of transfer is what is considered? All of agree? FMB on the date of transfer, students, is what? Okay, perfect. Now, this is what is also being referred in this case. This is something 67.6 only says. So, how much is the FMV? 175. This is the valuation. So, is this a valuation game? I told you already, while you do the computation, you will find yourself multiple valuation provision that you will have to take into account. So, here logically, I have done the transfer in year number two. I require the value in the year number two. Because I have not sold the asset, I don't have the outright value. Because I have not sold the asset, I don't have the outright value. So therefore, a valuation is required. And what is the valuation in this case? The fair market value, which prevails on the rate of transfer, is what is to be taken. In this example, it is 175. And then, students, in this case, the cost of acquisition, what it will be? Cost of acquisition, students. Cost of acquisition would be, in this case, is 100. And accordingly, students, 75 becomes the capital gains. Now you tell me whether this capital gains, should I say this to be a long term or short term? This capital gain, tell me, students, should I be saying this to be a long term capital gains or a short term capital gain? What should I be saying this as? I need an answer, students, from all of you. Quickly. All of you, students. Give me the answer. Whether this particular thing, will it be a long term or it will be a short term? This is my query. Quickly. Long term or short term? Fast students. And students, in this particular case, Radha, Kaniya, Gayatri. Indeed, it is a short-term capital gains. All of you have got the answers right. So in that scenario, students, what was that you are comparing? The question was, what was that, students, then you are comparing? So your comparison, students, was, in this particular context, students, your comparison was on what? Year 1 to year 2 or year 1 to year 4? What you are comparing? Not year 1 to year 4. You are comparing year 1 to year 2. That is it. Nothing more. Students. That is it, students. Nothing more. You are comparing year 1 to year 2. Not year 1 to year 4. Why? Because when we talk about period of holding, you were talking about period of holding, isn't it? Period of holding as a capital asset is what has to be seen. And as a capital asset, from which period to which period he was holding? As a capital asset, for which period to which period was he holding? That all of you are aware of it. So that was, students, from year number 1 to year number 2. Because after that, he was not holding it as a capital asset. After that, he was holding that as a stock in trade, which is not a capital asset. And therefore, when you talk about period of holding, the period of holding has to be as a capital asset, students. Perfect. Very good. Now, I hope that all of you are clear with this one. So just write, I think long-term capital gains, all of you have written in this case. Everyone. Long-term capital gains. So please write. Just put it, or maybe just write over here. You say it's a long-term. Long-term capital asset, POH. What is POH? Period of holding. Year 1 to year 2. Always keep these aspects in mind. Huh? And the period of holding as a capital asset is what has to be seen. Students, period of holding as a capital asset is what has to be seen, is what you need to always bear it in mind. Period of holding as a capital asset. Because after year 2 to year 4, the period of holding was that of stock in trade. After year 2 to year 4, the period of holding was that of stock in trade. Is that point clear to all of you, students?
Sir, it's short-term capital asset, not long-term.
Oh, sorry. Good that you rectified. STCG, students. This is STCG. STCA. STCG, STCA. Period of holding year 1 to year 2. As a period of holding as a capital asset. Now, in the same year, students, year number 4. So, what was chargeable in year number 2 as a capital asset being transferred? That chargeability is finally materializing in year number 4 for the head capital gains. That chargeability is finally materializing in year number 4 for the purpose of chargeability. then not only the capital gains, students, also there would be a business income. Also, students, will there be a business income? And the answer is yes, there has to be a business income. And that's exactly the point. So, the PGBP, students, the charge of section 26 will also come into play. Now you tell me, in that case, at what price that the stock in trade was sold? Sale of stock in trade. So therefore, here in the sale of stock, SIT, 300. Okay, 300. And against that, what is the cost that I'm going to take? Shall I take cost to be 100? Shall I take cost to be 100? Answer is no. Because already from 100 to 175, that much of the value, that much of the value from 100 to 175, that much of the value, how much of the value? 75. That much difference of the value is already charged in the head capital gains. That is a specific charge. So if it is a specific charge to the extent of 175, to the extent of 175 students, there is a specific, to the extent of 175 students, there is a specific charge. All of you agree? So what is left for the general charge under the head PGBP is what, students? Is the cost that will be taken. What is the cost? The fair market value, which is 175. And this will give you the business income of how much? 120. So why is it that they have to, now is this fair market value defined? Yes, again it is defined. The cost is getting defined. And what is the logic of defining the cost in such a way? So as to prevent double taxation. Because if you don't define, then chances are there that you may then take 100 as your cost. And if you take 100 as your cost, then your gain for PGBP will become how much? 200. But that will result into a double taxation to the extent of rupees 75, because from 100 to 175, that much of the difference is already charged under the head capital gains. So therefore, what is left for PGBP is from 175 and onwards. What is left for PGBP is from 175 and onwards, and that is specifically defined under the head capital gains. And what is the role that it is playing? The role that it is playing is to avoid double taxation. That is the reason, my students, why we are finding some of the definitions, some of the valuations of full value of consideration, or some of the valuation of cost of acquisition that you find, the objective is to avoid double taxation. This I have already given you the example. I hope that all of you are clear with this one. Can we now quickly run through the next one? So this was the first exception. So year 4, two charges happening. One is a specific charge under the head capital gains, and one is a general charge under the head PGBP. Specific charge under the head capital gains is under section 67 subsection 6. General charge under the head PGBP is to section 26(1). I can proceed now, students, to the next one. Now, the next one, students, is a very interesting one. Now, students, in the transfer definition that you have seen, in this case, so this was the first point, conversion of capital asset into stock in trade. Although it is a transfer, but the charge is not in the year. The charge, students, is not in the year of conversion, but it is postponed in the year in which the stock is sold. Therefore, that is the first exception to the general charge. Second exception, right? Please write the second exception to the general charge, right? Point number 2. Second exception to the general charge under section 67(1). Second exception to the general charge under section 67 subsection 1. Right, students, in that? Compulsory acquisition by law. Compulsory acquisition by law. A compulsory acquisition by law is considered as compulsory acquisition of capital asset by law. Compulsory acquisition of capital asset by law is considered as transfer. Is considered as transfer. Full stop. However, However, the year of charge, the year of chargeability, the year of chargeability of capital gains the year of chargeability of capital gains is not the tax year, is not the tax year of transfer in the bracket, right? That is the year of acquisition. That is the year of acquisition. But the chargeability is attracted. The chargeability is attracted in the tax year in which, in the tax year in which the year in which the year in which the compensation or part thereof, the compensation or part thereof is first received. Is first received. Please write, students, the section 67, subsection 12. Students, please write 67, subsection 12. And 67, subsection 30. So again, if very quickly I have to run through a particular example for the same. So what exactly would be the example, students? Supposingly here is a capital asset. Here it is a capital asset. Okay. Now this is year one. Anything like building. So building, students, as you know, because of the construction of metros, highways and all, many of the through compulsory acquisition by law, many of these particular assets are being taken for ensuring those infrastructure project can be unleashed. So therefore, I had a building. Say the cost again, year one is say rupees 100. The cost say rupees 100 in year number one for that building. Now somewhere, students, say herein in year number 5, fine, there is a compulsory acquisition by law. Compulsory acquisition by law. So is this the year of transfer? As per the definition that you have referred, is this the year of transfer? Yes, it is. If it is a year of transfer, then 67 subsection 1 says what? This should be the tax year in which the charge is attracted. This is a tax year in which the charge is attracted. But the SSC says, I don't have the money in my hands to pay the tax. Where is the money? I have not yet received. So I haven't yet received the money. The money was received in the subsequent year, say in this case, but that was received in parts. The money was received in the subsequent year. The compensation was fixed. Though the compensation was fixed, students, here in the compensation amount was here rupees, in this case, 400. But in year number 6, students, in year number 6, only 200 was received. And the balance 200 was received in year number 7. balance 200 was received in year number 7. Therefore, the question arises again, the same question, students. And what is the question? Whether it is year number 5, answer is no, 67.1 not applicable. Year number 5, students, you have to forget year number 5. Why? Because year number 5 was only for 67.1, the general charge, but general charge is not getting applicable here. So 67.1 is not, not getting applicable. So leave that resistance of 67.1, not applicable. What about year number 6? 200 students over here in this case. This is the first year in which the charge will be attracted. Students, this will be the first year and the only year the charge will be attracted. Now you will say, but sir, we have received only 200 rupees. And the next 200, next installment we are receiving in year number 7. So whether the chargeability will be split in those year 6 and year 7 in equal proportion? Answer is no. There will not be any split in chargeability. The charge is in respect of 1 year, and which is year number 6 itself. Here we don't use the word that percentage of completion method kind of a thing. Nothing of that sort is to be done. So accordingly, students, here year 6, therefore, in that case, section 6712, student section 6712 says it is year number 6. Year number 6. Tell me, students, quickly, what would be the full value of consideration if chargeability is in year number 6, in which I receive the compensation or part thereof. I receive the compensation or part thereof. Then year number 6 is my year of chargeability. My question, therefore, to all of you is, what would be my full value of consideration in this case? My full value of consideration, students, in this case will be 200 or 400, entire 400 students. So accordingly, in this section itself, FBC says what? Entire 400 students. Entire 400. That is 200 and 200. All would be charged. Entire compensation amount would be charged in the tax year in which you receive your first installment. In the tax year in which you receive your first installment. I hope that all of you are clear with this one. And if that is the case, now that takes us to the next particular part. And what is that, Fritz? What would be the cost of acquisition, therefore, in this case? Cost obviously would be 100 in this scenario. Now, accordingly, every one of you are convinced that it will be a long-term capital gains. Long-term capital gains. Now, let me still ask you a question. Long-term capital gains. Let me still ask you a question. Period of holding that you have taken was from which year to which year? The period of holding, students, that you have taken was from which year to which year is my question. Now I need an answer from all of you. Tell me from which year to which year you took the period of holding to decide whether the asset is long-term or short-term. Quickly. In this example, what was the year, students, that you took to decide from which year to which year you took to decide the period of holding? In this example. Quickly, students. Let's see. In this regard. And the answer is by 3. ICDS, please don't use ICDS here. ICDS is applicable only when it is for the two heads of income, and these two heads of income are PHBP and IFOS. When it comes to any other heads of income, ICDS will not have any applicability. Okay, so therefore, please never, ever, ever, ever apply ICDS other than to the two heads which are PGBP and IFOS. Is that point clear to all of you, students? Now, from year 1 to 6, 1 to 5, what exactly it is, students? What exactly it is? That becomes a question, isn't it? So now, again, let me ask you a question over here. I have already introduced the principle to decide. Students, you should always learn the principle. not the provision, or not the facts. Learn the principle, half of a job is done. Period of holding, I told you. Period of holding. Holding as what? As a capital asset. This was second thing. Period of holding. But you should hold something, isn't it? And that holding should be as a capital asset. Here, tell me, from year number 5, although I'm doing the computation in year number 6, did I hold that asset in year number 6? That is the year of computation. Did I hold it? No. I was holding that asset from year number 1 to year number 5. That is my period of holding. And that will ultimately decide whether the asset is a long-term or a short-term capital asset. Is that point clear to all of you students? Every one of you. That will only decide whether the asset happens to be a long-term or a short-term capital asset. So, period of holding. Holding should be as a capital asset. So, here the compulsory acquisition happened year number 5. Holding therefore is from year 1 to year 5. Holding therefore is from year 1 to year 5, and accordingly in that context, the asset will be characterized as a long-term capital asset. Is that clear to all of you? I hope that every one of you are clear with this one. Every one of you, you just can't miss out on these things. That's what, if you start probably missing out on these small things, I can assure you one thing, that when you start hitting to the set off and carry forward or the total income, at that stage, students, this will have a very dangerous proposition. So these concepts are very critical, students. You should be very clear about them, their applications. And that is exactly what it is. I hope that all of you are clear with this one now. Everyone. Perfect. So let's now take it further. So I had introduced already the second exception now, students, here. I have introduced a second exception over here, students, isn't it? Now come, students, the third one. Be careful, students. One by one. See what I'm trying to do. I'm holding my general charging section 67.1. I'm holding my fort of my general charging section 67.1. And now I am finding that the general charge is not getting attracted because of this reason. One was, I have already given you 2 cases. We have to build up now other cases also. Let's build up the other cases, students, in this regard. Let's build up the other cases. One of the case, students, one of the other case, let's have a look quickly. Another case. Students, in your definition of transfer that you already have read, students, in your definition of transfer that you have already have read, read it one more time. All of you, read it one more time. Read it one more time, students. The definition of transfer. 2 clause 109. Fine, students. Perfect. Let me give in now third point, students. First point, exception you have referred, conversion of capital asset into stock in trade. Second was, students, the compulsory acquisition by law. Now the third one, students. All of you. Students, third one. Third one, in this case, students, what happens is that the third one, Students, what has happened is this, that SSC has had an asset, capital asset. Again, the tax year, say the year is tax year 1. Okay, tax year 1. Now, what is happening is this, that say in year number, students, year number 3. Be careful, students. Year number 3, what has happened is there was a destruction. Students, there was a destruction of the capital asset. CA is a capital asset. So there is a destruction of capital asset, and the insurance compensation money was received. Insurance money was received. Destruction of capital asset and the insurance money was received. That happened somewhere in year number 3. Okay. Or may I say destruction has happened. Just let me put more complication. Destruction of the capital asset. Obviously, the surveyor has came, did the assessment, and finally the assessment by the insurance company got crystallized in year 4, and the money was received. Money was received in year number 4. In year 4. Say the money received was say rupees 200. Cost was say rupees 100 crores. 3 years period, students. Which are the 3 years period? Year number 1, capital asset was acquired, 100 crores. Year number 3, there was a destruction of a capital asset. And then year number 4, money has been received in year number 4. Insurance compensation proceed was rupees 200 crores. So this money received in year 4 from insurance company. This is insurance company proceed. Okay. So now then, students, let me in fact give you a particular some background aspect over here. Students, over here there was one particular judgment or very old judgment of 90s. Vanya Silk Mills Supreme Court. Okay, that judgment is important for the purpose of this concept to be known. Students, in the definition of transfer, students, that you have seen, the SSC, if you see the definition of transfer 2 clause 109, what you have seen? One of the element of transfer is extinguishment of right. You already have read the definition of transfer, section 2 clause 109, and what does it say? Extinguishment of right is equal to transfer. That is what you have seen, isn't it? Now, what happened in this particular case was that the asset got destroyed, the SSC received the insurance compensation money. The question that came up before the Supreme Court was that whether the insurance compensation money which has been received, can that be chargeable under the head capital gains? The assessing or the department students was of the view that there is a transfer of a capital asset, transfer in the nature of extinguishment, and therefore because the asset on destruction has ceased to exist, the asset on destruction has ceased to exist, therefore it is a transfer of a capital asset, and accordingly the chargeability has to be attracted under section 67(1), the general charge. At that particular point, students, the Supreme Court gave a landmark decision. And what it said was that what has to be seen, be careful, students, what has to be seen, as when you talk about extinguishment, what has to be seen is the extinguishment of the right of the SSC in that asset. What should be seen when you talk about extinguishment as a transfer? So what should cease to exist? What should cease to exist, students? What should cease to exist is the SSC's right in that particular asset. The right in that particular asset should cease to exist, and not the asset itself. And not the asset itself. So, extinguishment of right is what is the transfer. So, my right in that asset should cease to exist, not the asset itself. Where the asset itself has ceased to exist, where the asset itself has ceased to exist, it cannot be considered as a transfer under section 2 clause 109, and accordingly it could not be charged under section 67(1). Under section 67(1). And therefore the government thought that now this becomes a situation for us, because what they are trying to say is that what should cease is the assessee's right in the asset and not the asset itself. So if you are supposed to say that, sir, this is the transfer means cessation of right and not the cessation of asset. If it is a cessation of the asset, then it cannot be considered as what? As a transfer, students. If it is a cessation of the asset, it cannot be considered as transfer, and that exactly is the point, students. So therefore, what the government did, they created a specific charge. They knew that 67 subsection 1 will not be made applicable. Why 67(1) will not be made applicable? Because 67(1) requires what? The existence of a transfer. 67(1) require what? Transfer to take place in this context. Now in this case, transfer as per the Supreme Court means what? Cessation of right. Whereas here, what has happened? Cessation of asset. So therefore, it is not like a transfer of section 2 clause 109. And if it is not a transfer, charge of 67(1) will not be attracted. And therefore, if still the government wants to charge the insurance money, still the government wants to charge the insurance money in absence of 67(1), then do they have to create a specific charge? Do they have to create a specific charge? Answer is yes. And that exactly what they have done, students, over here. Students, please have a look. They have created a specific charge in this case. And that exactly is the point. So the charging section, students, special charge that you can all see over here. The special charge. Now, 67(2), that exactly is the case. Which is the tax year in which the chargeability is attracted? The tax year is the tax year in which the money or the other asset is received. So, in my example, the money destruction happened in year number 3. In my example, I'm not recollecting the year now, but you can see from your notebook, it happened somewhere in year number 3, but the money was received in the next year. So, it is the next year when the charge will be attracted and not in the previous year, the earlier year. So see the trigger of 67(2). Money or other assets received under insurance because the capital asset is damaged or destroyed, students. Because the capital asset is damaged or destroyed by specific event. Natural convulsion, riot, civil disturbance, accident, fire, explosion, or enemy actions. These are the specified events. Please write, students, in this case. I think that you have already copied the chart, students. On this, the case study that you have made, already have copied it. Quickly tell me, students. All of you. Confirm. Just confirm all, students. Gayatri, Radha, Kanhaiya. Okay, just have a look once, all of you. Please write, students, on that point number 3. Destruction of capital asset. Destruction of capital asset is not in the nature of transfer. Is not in the nature of transfer since the transfer requires an extinguishment of right in the asset, an extinguishment of right in the asset and not the asset itself. And not the asset itself. Full stop. Where the asset itself cease to exist on account of the specified events covered in section 67 subsection 2 then it is not a transfer. To attract the charge. Under section 67 subsection 1. Under section 67 subsection 1. And hence a specific charging section under section 67 subsection 2 under section 67, subsection 2. Seeks to charge. Seeks, SEEKS, seeks to charge the insurance money received, the insurance money received due to specified events, full stop. Due to specified events. Full stop. The year of charge is not the year of, the destruction of the asset. The destruction of the asset. But it is the year of, when the money is received, when the money or other asset is received. Now tell me one thing, students. Last question before we hit for a break. Last question, students, before we hit the break. What would be the period of holding here? I give you again two options, and I hope that all of you participate to the answer. I give you two options. Period of holding, from the year of acquisition till the year of destruction. That is option one. And second is from the year of acquisition till the year when the money was received from the insurance company. That is my second option. So what is correct, students, over here in this case? I give you two options, students, in this scenario. Considering that the year of destruction and the year when the money was received, they are two different period or two tax year. So what should be my period of holding when I have to decide whether the asset would be a long term or short term? So start point is a year when I have acquired the asset. That is the start point. From that period, students, from that period till the year of destruction, that is the first case, the first option. Second option I'm giving you, year of acquisition till the year in which the asset was, the money was received. So quickly, students, all of you. Everyone have to give. See, right, wrong doesn't matter. Everyone has to give the answer. So just again, students, in this context, again think on this particular point. Period of holding. Okay, now till which year I have held the asset? Holding, now see the word. I'm just going with the nomenclature of the word. Just take the same and plain meaning of the word. Na? So period of holding, students, in this case. The question is for which period to which period I have held the asset in this context. Radha, just hold on. Till the year in which I had this thing, that till the year the asset was in my particular possession. Once the destruction happened, was I holding the asset, students? Once the destruction happened, was I holding the asset? Answer is no. In this case. So I was holding the asset till the date when the destruction took place. Till the date when the destruction took place. So therefore, my period of holding also will have to stop on that date. Which date? The date when the destruction has happened. So from that date of acquisition till the date of destruction is the period which I will consider to decide whether the asset is long term or short term. I hope say next year I am receiving the compensation. Was I holding that asset that time? Next year? No, asset was not there with me. Cessation of asset already happened. Asset ceased to exist. So if the asset has ceased to exist, where is that I am holding the asset? I am not holding the asset. I hope that all of you are clear with this one, students. No confusion whatsoever. Fine, students. And that exactly is the point, students. So I hope that every one of you are clear with this proposition now. With that, students, now let's take a break quickly. Okay? Let's take a break, students. And then thereafter, quickly let's take a break. Perfect, students. संगीत स्टार्ट करते हैं. So now, friends, what you will do? Two things that you are going to students do it very carefully. One is about the revise this entire concept that we have discussed. You may refer the module also. In any case, the notes, and I think you have already taken a note as well. The main thing, friends, is the definition of capital asset, definition of transfer, the general charge of section 67(1), and then thereafter the specific charge that we have unleashed. Because the next session, okay, by the way, students, Saturday, being an Independence Day, Saturday is an off. So, students, the next session, probably, I'm going to unleash buyback. On the theme that we discussed just now, we will do the buyback, and there is a very important amendment, students, which is there. I don't want to take the buyback now at this stage, so I'll use the next class for the buyback part. And if you can just do one favor to me, students, because you have an off. If it is possible, students, just read section 70 and be ready. Section 70. From the module itself, you can read it. Section 70. Transfer which are not considered as a taxable transfer. The transfers which are not considered as what? As a taxable transfer. Is that clear to all of you, students? Radha? Kanaya? Gayatri? So just read that section 70, which are the cases of the transfer which are not considered as a taxable transfer. Why I'm saying so? Because that will help me or enable me to really take you to the advanced level of interpretation, which you need to know primarily. So just a bit of familiarity also will help. A bit of familiarity, students, in this particular case will also help. Okay. So just that particular thing, students, is required. The rest of the things are perfectly fine. So now, let's start with. Yeah, just rather section 70 from the module. I think you all can download the module from that PDF 70 and whatever you have done it. So that, students, we can then get into the advanced level of coverage on this particular topic, okay? From the next particular class onwards. The basic primary, I have already unfolded it. I want to now take you to the. Acha, if it is not there, module has not been uploaded of the capital gains. So yes, Bare Act also, students, Bare Act any case, section 70. Just read it. Primary. I just want you to have a familiarity of the provision of section 70. Again, I'm repeating, students, transfer which are not considered as a taxable transfer. So the fact that, students, now I don't want to get into the amendments of buyback. Let's try to, students, use now that PGBP part. We will be targeting one question also, but before I target that question, students, I would want the general deduction to get over. This general deduction, students, as you know, you all are familiar in earlier avatar of section 37(1). It was under section earlier avatar of 1961 Act. It was under section 37(1), isn't it? Now it is in the new avatar. It is under section 34. So if you see over here, primarily in this case, statutory provision, section 34 of the Income Tax Act. Section 34 is the residuary provision for deduction of business expenditure. It corresponds to section 37(1) of the Income Tax Act 1961. So it corresponds to what? To section 37(1) of the Income Tax Act 1961. Now, students, there are some core conditions that needs to be fulfilled. Just read this condition, students, you all are aware. I just need to get into some very advanced level discussion with all of you over here. So the four conditions, students, as you all are aware, what are the four conditions? The four condition, as you all are aware in this case, is the first one, students, is about the expenditure should not be of the nature specified in section 28 to 33, 44 to 49, and 51 and 52. In this case, means in a simple word, students, the first condition says that these expenditures should not be covered specifically under any other section, because we know that there are specified deductions which are there in those specific section, like depreciation, capital expenditure section that we discussed last time, tea, coffee, rubber development allowance, so on and so forth. So they have given all the sections where whatever we have discussed, the deductions, primarily employer related provision, isn't it? So therefore, the employer related provision, all those lists that you discussed, students, bonus and commission. So that if you have to be in 34.1, you have to ensure that you are otherwise not covered in a specific manner in any other specific provision of deduction. Point number B, it should not be in the nature of personal expenses of the SSE. That goes without saying. And the third one is have been made or expended wholly and exclusively for the purpose of business or profession. See that? It should have been laid out wholly and exclusively for the purpose of business profession. And last one, students, is capital in nature. Now, students, that's the reason why I told you. Whenever you read something, if you read this one, students, you will find three negative clauses. Three negative clauses, students, and only one positive clause. You will learn you are learning three negative clause. There are three negative clause. What is that? Should not be covered in those specific sections, should not be personal in nature, should not be capital in nature, and should be wholly and exclusively for the purpose of business and profession. As a thumb rule of interpretation, students, I'm telling you, a negative provision. They could have also written in a positive manner, na? But instead of writing in a positive manner, they are writing in a negative manner. Any provision written in a negative manner, students, you need to do the interpretation in a very strict manner. The strict interpretation is required. And therefore, this is right like this. Rather than should be laid down wholly and exclusively for the purpose of business profession. That's the only positive part. Next, over here, statutory exclusions are given to you. Expenditure not regarded as laid out or expended wholly or exclusively. These are the statutory exclusion, meaning thereby in section 34 itself. These will not be considered as for the purpose of business and profession. So, what are the items which they themselves have told or specified that this is not to be considered as for the purpose of business? Point number one, any expenditure which is considered as an offense under any law or which is prohibited by any law for the time being in force in India. That is the first one. The second one, students, is providing a benefit or perquisite to a person in violation of any rules, regulation governing that person. For example, freebies to medical practitioners. I hope that you are aware of that. Like if you give a free, generally, pharmaceutical company gives freebies to the medical practitioners. Do you know why is it so? Because then that freebies, which is nothing but the sample medicines, then they start using those sample medicine and they give it to the patient. And then the patient, when they have it, then what happens? Their body gets customized to the dose of that medicine, and hence whenever they get that particular, say, fever or so, they will be used to that particular medication, and therefore it is considered as an illegal practice by the medical association. So therefore, if you see, providing a benefit or perquisite to a person in violation of any law, rules, or regulation governing that person. So these are for the practitioners. Regulation governing that person. Compounding of an offense under any law in force or outside India. Compounding of any offense, students. That is also to be considered as for the purpose of business and profession. Specifically held not to be considered as for the purpose of business and profession in this context. Settling proceedings initiated in relation to contravention under laws notified by the CG. Students, settling of the proceedings. So, settlement of the proceedings, on that basis, whatever expenditure I have incurred on settlement of my proceedings, under which law, which is notified by the CG. So, they have given students in this case, originally, they have given students for the income tax law. They have given students for the income tax law. So, any settlement that takes place under the income tax law or SEBI Act or Security Contract Regulation Act or the other two other acts, Depository and Competition Act, if you are making a payout expenditure on account of the settlement that take place under these acts, whether these expenditure will it be considered as wholly and exclusively for the purpose of business and profession? Law says no. We say statutory provision, they say it will not be regarded as to be incurred for the purpose of business and profession. Point number 5, students, expenditure on activities relating to corporate social responsibility. Students, be careful of CSR, referred to under 135 of the Companies Act. You need to know these things, students. That is one thing which has been there. So, expenditure on activities relating to CSR. Next, point number 6, expenditure on advertisement in any souvenir, brochure, tract, pamphlet, or like published by a political party. Any newspaper belonging to a political party, in that a company, if they are doing any advertisement, if a company is doing any advertisement in that particular newspaper which is belonging to that political party, whether that expenditure will it be allowed as deduction? Answer is no. Point number 6. Okay. Now, students, this particular part, point number 1, students, is very frequently asked. Just pay attention to this particular part, point number 1, in this context. Now, if you see point number 1, expenditure for any purpose which is an offense under any law. One very popular question in the examination, students, that they ask is statutory penalty versus contractual penalty. Understand what I've said? One very popular adjustment question that they ask is statutory penalty versus what? Versus the contractual penalty. Now you tell me, students, in this case, a statutory penalty, students, a statutory penalty is what? What do you mean by statutory penalty? In law, the penalty is paid, a fine is paid. Like you have filed a late GSTR, and because of filing of the late GSTR, penalty is imposed under the GST law. Now question therefore is, GST payment is allowed as deduction. Whether GST payment is allowed as deduction? Answer is yes, but yes, it will be allowed on payment basis, because that section is those sections which require the amount to be paid. Remember bonus commission, then employee related PF and other fund, gratuity fund, leave encashments. For them, we already discussed that they will be allowed as deduction only when the payment is made in the tax year or up to the due date of filing of the ROI. In that, even the indirect taxes, payment towards indirect taxes, that also is allowed to you as a deduction, provided you make the payment in the tax year or up to the due date of filing of the return of income for that tax year. But here, am I talking about the GST payment or penalty under the GST law? Penalty under the GST law. Is this penalty, this penalty, or is on account of any prohibition? Because of any prohibition which was laid down under the law, or because of it any violation in that particular law? Answer is yes. Answer is yes, students. And because of that, statutory penalty is imposed under the GST law. So, GST payment allowed to as deduction. Penalty on GST disallowed. Why? 34.1. 34.1, students. I hope that all of you are clear with this one, friends. Now, friends, I have given you a list of these examples. So, the notes, any case, will be given. I think this notes also will be there, will be given. Please ensure that these lists are always gone through by all of you carefully. Mainly, you will find the adjustments getting covered from here. But what we will discuss, students, one very important part. Students, remember on one thing. One note I just want all of you to just take into account. Capital expenditure, students. Treatment of capex. Now, if you see treatment of capex, this is what I'll say. Incurred in specified business or purpose. Like last lecture, students, we did specified business, isn't it? So, two things, specified business. So, what we have written, eligible capex, because remember in specified business also, few of them were ineligible, few expenditure students were ineligible. So, eligible capex was allowed as deduction. Now, specified purpose, students, specified purpose. Now, if you see specified purpose here also, eligible capex. Specified purpose. Which are the purpose like scientific research? Scientific research, students. Other than the skill development or rural development, I gave you this as a homework, students. Skill development, the next section after scientific research was this. Even in that, the eligible capex was allowed. Just ensure to take a note of it. You may refer it that thing later on, that is fine. But just keep in mind that there are other ones which I have given you as a homework, skill development or rural development. Now, incurred in the specified business, incurred in specified business or for specified purpose. Incurred in specified business or for specified purpose. Now, this is the case. Now, that is the first one. For the other students, be careful now. For all the other cases, students, for all the other cases. So one already we have seen this, and for all the remaining cases, what exactly is the point? So for all the remaining cases, students, be careful. Be careful, students. For all other cases, is it for, is it depreciable asset? Is it depreciable asset? If yes, then students, depreciation allowance, not a depreciable asset. Then students, just now we have seen, if it is not a depreciable asset, then section 34(1), what it does? Disallowed. 34(1), students, what it does? Disallowed. This is what exactly is the situation, students, for the other cases. Capital expenditure, no? Capital expenditure disallowed. Fine. Now, ultimately, students, what is therefore very important for all of us right now is to understand what do you mean by, students, by now we need to understand what is a capital expenditure. There is a history of case laws right from that very old judgments from 60s and all. Then the first landmark judgment, students, happened somewhere in 70s through Empire Jute Company Limited. Supreme Court judgment. Dhani Palkhiwala, he fought that particular case. Wonderful judgment. First time we got a particular landmark ruling, and that ruling, students, even stands today. So whatever Prami now you know, everything will fall in that particular judgment. Empire Jute Company. Students, the assessee has incurred an expenditure that expenditure is giving an enduring benefit. Just because the expenditure is giving the SSC an enduring benefit, is it sufficient therefore to say that the expenditure is capital in nature? Just because the asset is giving the SSC an enduring benefit, therefore whether is it sufficient now to say that it is capital in nature? Can we say so? Enduring benefit, the asset is giving him the enduring benefit. Can therefore I say it is a capital expenditure? Answer is no. I can give you an example. Say for example, students, advertisement expenditure. So if you are incurring an advertisement expenditure, students, tell me whether it is giving you an enduring benefit. Answer is yes. And because it is giving you an enduring benefit, whether you will say this to be a capital expenditure, answer is no. What Supreme Court says that you have to also see whether the expenditure is in the capital field or not. Whether the expenditure, whether it is in the capital field or not. Do you know what is a capital field, students? By the way, what is a capital field? Capital field, if you have to visualize, capital field, this is a term that they've used. So, enduring benefit test is not relevant. What has to be seen? Whether the expenditure is in capital field or not. What has to be seen is whether the expenditure is it in the capital field or not. This is what has to be seen, students, in this context. This is what has to be seen. Now, what do you mean by capital field in this regard? Now, if I have to tell you capital field, students, capital field means something which is permanent. Capital field means something which is a part of a permanent structure. And tell me, students, what is permanent? If you see the balance sheet, what is permanent? If I have to just ask you from the balance sheet, only two things, if you see in the balance sheet, are permanent. One is the shareholders fund. Shareholder fund, students. That is the case. This is something which is permanent. And second one is about, students, is a fixed asset. Fixed asset. So Supreme Court says that if just because an expenditure is incurred and maybe that expenditure may be giving you an enduring benefit, that by itself does not mean that you have incurred a capital expenditure. What also have to be seen, students, what also we need to see whether there is any change in the capital field, whether there is any change in the permanent structure. And what is permanent? Shareholders fund or the fixed assets. These are the permanent structures. What do you think about any item other than that? Like for example, debentures or for that matter, loan. Are these a permanent structures? No, today it is there, tomorrow I'm going to repay. There is an obligation to pay. So because there is an obligation to pay, it is no longer a permanent item. Fixed asset, yes, there is a degree of permanency. To extent of their life, there's a degree of permanency. Shareholder fund, there's a degree of permanency. Why? Because I don't have any obligation to repay. So what the Supreme Court said that just don't see the enduring benefit test. Check whether there is any change in the capital field of the business. So therefore, only when there is a change in the capital field of the business that the expenditure will be referred as a capital expenditure. Please write over here after this chart. Please write this landmark particular decision. And children, this is a 78. I think Empire Jute Company Limited was held somewhere in 70s. 2026 students, we are doing this today. Last year we had this sharp one Supreme Court judgment on payment towards non-compete. It is covered in our module, students. But the principle is the same. Primarily, you will find that 2026 or maybe till this act will survive, the principle will remain the same. And this is a test with the golden rule. Please take a note of it. An expenditure is, just write, students, just write. Just because the expenditure is providing an enduring benefit, just because the expenditure is providing an enduring benefit, that by itself does not that by itself does not means the expenditure is capital in nature. Means that the expenditure is capital in nature. Full stop. What has to be seen is whether by incurring such expenditure, whether there is a change in the capital field, of the business. Change in the capital field of the business. Change in the capital field of the business. And what is capital field? Students, in the bracket you can write shareholder fund or fixed asset. Just keep this in mind. Shareholders fund or fixed assets. Okay? Full stop. Now write in the next line. Therefore, expenditure incurred. In issue of shares. Or the right shares is an expenditure in the capital field of business and hence will be allowed as deduction. Point number 2. Next line, friends. Whether expenditure incurred in issue of bonus shares is also considered as a capital expenditure. Put a question mark. Now, students, you tell me, is by issuing a bonus shares, students, pay attention to this one. By issuing a bonus shares, do your shareholder fund changes? By issuing a bonus shares, does your shareholders fund, does it changes, students? Answer is no. The shareholder fund, students, remain as it is. Do you all agree? In this case, the shareholders fund, students, remain as it is. You can rather get this thing later on towards it. It does not change, students. It does not changes. Why? Just see the journal entry. You are only capitalizing the profit. General reserve, family, to share capital. General reserve is also part of the shareholders fund. And to share capital. And that's exactly the point. So therefore, what I'm saying is that by issuing the share capital, students, in this case, by issuing the share capital, there is no change in the shareholders fund, and hence this expenditure is not capital nature. What is the test I told you? The expenditure should result into some change in or the expenditure is on account of some change in the capital field. And if there is no change in the capital field, then such expenditure that you have incurred will not be considered as capital nature. Please write, issue of bonus shares does not bring any change, does not bring any change in the capital field of the business, in the capital field of the business, and therefore, such expenditure, such expenditure is not capital in nature, is not capital in nature. You have to write this reason. I know the name of the case law also. That case law is already there in the notes. Brook Bond India Limited or General Insurance Corporation. But you just forget the name for that. Just attack the principle. If you can attack the principle, many of the case law students you don't have to remember now. Now the recent judgment, students, was about the Sharp. The Sharp judgment 2025, Supreme Court again. What happened was that, students, non-compete agreement was entered. Now, please pay attention and please apply that 1970s judgment of this Empire company, Jute company. I think Radha, yeah, you got it right. 1980, yes. And yeah, that was the time. That was the end game, 1980, after the High Court and Supreme Court. So let's look upon to a non-compete agreement. In a non-compete agreement, we remember we were doing general chargeability. General chargeability, students. When we were doing general chargeability at that particular point of time, we already concluded that amount received. So here, in this case, Mr. A, they are all in business. Mr. B. Mr. A pays him, say, 5 crores towards non-compete agreement. So, to Mr. B. Now, Mr. B, being a recipient, we already have done from specific charges that enter that PGVP. Amount received on account of non-compete agreement. Specific recipient, specific charge exists, students, under section 26(1). Under section 26(1), specific charge under the head PGVP. That is under the head PGVP. Question is on the payer Mr. A. For this particular payer, for him it is an expenditure. For him, students, it is an expenditure. So whether this expenditure, students, whether this expenditure, will that be allowed? Students, whether this expenditure, will that be allowed as deduction? That becomes a question. Now, what is the test of 37(1)? That is the question. 34(1), students, section 34(1). 34(1) primarily says one thing, that 4 tests, 3 negative, 1 positive. 3 negative tests says it should not be covered in a specific section. The deduction should not be covered in any of the specific section. This deduction is not covered in any specific section, students. This deduction is not covered in any of the specific section. Okay, that is what is your 34(1). This deduction is not covered in any of your specific section. Non-compete agreement expenditure not covered anywhere for deduction purpose. Neither it is a personal expenditure of Mr. A. He is incurring for business purpose so that his profitability can increase. That is the reason why somebody, if I have to eliminate my competition, why I am paying you so much money? When I am eliminating my competition, I am paying you so much money because I want to ensure that my profitability increases. So it is not a personal expenditure that I am incurring. Now, is it for the purpose of business? Yes, it is for the purpose of business. The question now is, the last question becomes the most important question. Is it capital in nature? Students, is this expenditure a capital expenditure? Is it a capital expenditure? Is the question, students. So, is this an expenditure, students? A capital expenditure, students, in this context? Now, what I told you, students, by paying this expenditure, did Mr. A has affected any change in his capital field? By non-compete agreement payment, students, by non-compete agreement payment, did it had any consequence on his fixed asset? On his fixed asset? Anything happened in his fixed asset? Answer is no. By making the payment of non-compete agreement, did it had any impact on his shareholders fund? Again, the answer is no. He is not raising a share capital. He is just making a payment. That payment he may do maybe by taking a loan. Doesn't matter in this case. But the fact remains is that by non-compete agreement, because of which if there is an expenditure which I have incurred, that does not alters or that does not changes my capital field. That does not alter my capital field, and because it does not alter or changes my capital field of the business, therefore is it a capital expenditure? Answer is no. And if the answer is no, then whether the deduction under section 34(1) is it allowed? Answer is yes. That is a sharp recent judgment, students. Could be an important one. So for the recipient, for Mr. B, anyway, it is taxable. But for the payer who is making the payment, is it an amount which is to be considered as an expenditure allowed as deduction? So we have referred the test of section 34(1). There were three negative tests and one positive test. In that three negative tests, the most important one was whether this expenditure which Mr. A is paying, can that be considered as a capital expenditure, for which I already have taught you the test. And the test says that check whether this expenditure is towards the change in the capital field. Answer was no, and hence this expenditure is not capital nature, and accordingly will it be allowed as deduction? Answer is yes. Answer is yes, students. I hope that every one of you are clear now. All of you confirm this one, students. This is, students, this is one thing. If you remember the principle, students, the things probably now become so easy. Do you agree? Everyone? Or else we keep chasing the judgments, isn't it? You remember the principle? 50, 60 years, judgment will keep on coming and will keep on going. It will be the same. Karaya? Perfect, very good. Now, students, this will give me a last particular thing. We have learned now the most important particular concept, students. Most important concept we have learned now of whether the expenditure is capital or not. This is the most litmus test. And now with that, students, now what I will do, students, I will just keep this particular slide open in case supposingly students, supposingly this is not there, then at least maybe the PDF is not been given to you, maybe in a day or two, then at least, students, you will be in a position to just I want next class, we will be solving it. But next class, before I solve it, I want you to make your honest try, and you will make a lot of blunders also. The total income question, students. Now this will involve even that specified business, students. I was talking about it, isn't it? That we will solve question, students. And then by the time assessment of various entity total income question will come, you will know that we already know. Practice will make the things perfect, students, now. So I just am giving you this particular part. This over here, if you can just see this particular thing, students. And just this 12 item, this is a beautiful question, students. But then this will depend upon how you are in a position to do it. I want your first effort, students. First effort has to be from you. Please make your best of the effort. Only then, students, your confidence will grow. You'll make mistake. I'm not saying that you will not make mistake. You people will make mistake. That is perfectly fine. But the next class, because it is going to happen on Tuesday, Saturday being an off. So I just want all of you to, I think you can just, if supposing you can see from YouTube also. Although the font you will say, but the font is very this thing. But still it is fine. No? You can see. I think that you all can see, isn't it? I just want you to give me the treatment of these items. Students, treatment of these items. Now I just have enlarged the font, students. I'm just keeping it for, say, maybe because when you would see it maybe from YouTube, you'll take a pause. You can pause it, isn't it? And just when you take a pause, I want all of you now, students, to go through this beautiful section. I've integrated it. The capital expenditure on scientific research, you will find that. Students, you will also find that notified agriculture extension project, which was a homework actually. There were two sections. One was scientific research and the other one was notified agricultural extension project. The next section you will find. So it is covered back to back. Section is already there in this case. So students, this is what it is. Okay. And then students, you will also find section 35. The beauty of this one, students, is students, you will also find section 35. Sorry, 34. Whatever is the general deduction, students. And students, in this context, do you know what is the best part? This company is in biotech and also operate a hospital with 120 beds. It has not exercised the option under 200. It has not exercised the option under 200 means alternate tax regime they are not taking. Why? Because they are getting big reduction. The following particulars relate to the tax year 26-27. Net profit as per this one is this much. Now there are two line of business, students. Please understand, specified business of hospital beds of 120. Students, 120 beds. It's a specified business. You can get the deduction of the eligible capital expenditure. That is one. Biotechnology. Remember where it goes. 46-2. 46-2, students. We already learned that. In 46-2, what we have learned? Capital expenditure, which is land, which is plant and machinery, will be allowed as deduction under 46-2. Yes. What about the building? Building for biotechnology, you will get a deduction under 46-1. That we all know. The scientific research expenditure, the revenue expenditure, that also will be allowed. Okay, so students, you are being given the particulars of revenue expenditure of scientific research. So this is scientific research, this is also scientific research, this is the notified agricultural project, which was the homework for you, 47. This was a skill development project, students. This is again the same thing. Souvenir to political party, just now we have said this. I don't want to discuss it actually. Otherwise, the point is that if I discuss it, then you will not do this. I just want you students to go through this one. Will you all do this, students? All of you? In this case. Okay. So I hope that all of you have gone through it. Just now, you can see it in the YouTube also. And when you see in the YouTube, please, I want your answer, students. You go through the respective section. Do the search. Students, do the search and all. Everything. And try to get the answer. Okay, maybe act or the notes that has been given to you or the module from the module. Students, your confidence will grow up that way and you would then be in a position to really get a formula. So we will do a lot of practice of this kind. Okay. So next class, students, again, you have got good task. Capital gains, please revise, students, whatever you have done. If you want, you can just go through this video one more time of capital gains at 2.5 hour session before the break. Go through this one more time, maybe on Saturday and Sunday. And then thereafter, Tuesday when we see next, I'll start with buyback. Huh? That's the reason why buyback has got heavy amendments. And I have also introduced a case study on buyback also. So we'll do that and then we'll move forward to the other cases of the business restructuring of the capital gains. Okay. See you then, students, in the next slide. Any doubt that you have, you can just ask me right now, students. Any doubts?
Yes, sir. You explained the treatment of capital expenditure. Sir, basically it is majorly occupying the PGBP part, right? So how it was being applicable to capital gains?
Capital gains, as in?
Sir, you explained right now with regards to the capital field and all such stuff right now. So
Yeah,
that's what I was asking. That it is already covered in the PGBP. So
it is
how it
only
is being
PGP.
related? It is of the yeah, it's of the PGBP. So capital gain portion is not over here. Whether to determine whether it's capital expenditure or not.
No, no, this is only we are dealing with this one because we just wanted to touch upon this 34 one. That's a tool. After the break, we'll touch upon that big problem of PGVP. So, therefore, this 34 one has in PGVP, we're talking about the capital expenditure. So, whether this capital expenditure, which you have incurred for business purpose, you are talking about the business. No? These are the expenditure for business. So whether this expenditure for business can that be allowed as deduction under 34.1? So 34.1 has got its own test for deduction under the PGBP. One of the tests is that the expenditure should not be capital in nature. Capital nature does not mean capital gains. For capital gains, you have to transfer a capital asset. So that is a different this thing altogether. Here we are talking about an expenditure that you have incurred for the purpose of business. Can that be allowed as deduction? 34th lays down the test. One of the tests is that expenditure should not be capital in nature. So what we were trying to understand was that what is what do you mean by the term expenditure is not capital nature? So for that I gave you that particular principle. That was it.
Yes, sir. Another one, you were talking about statutory penalty versus
I
contractual penalty.
you
You
also said
discussed about statutory, but what about contractual?
contractual penalty allowed. What is disallowed is only have to be disallowed. Other than like for contractual penalty, like for example in the contract, there is a say fine. Say the contract says that if you don't do this, you will have to pay penalty. Okay, so you have to see what is disallowed in this case. So what is disallowed is only the statutory penalties. So if there is any contractual penalty which is imposed and has been told you that this much of the penalty is debited in the profit and loss account, and that is how you have arrived at your net profit after debiting the contractual penalty. So will you disallow the contractual penalty? And the answer is no.
Okay, so contractual penalty is allowed as per Income Tax Act.
Allowed, no allowed. So,
Okay, but even in case of such statutory penalty and the penalty is being, it's being GST payment is done afterwards, not within the due date. So penalty is being levied. So whether that payment still it will be allowed when it is done after the due date.
GST payment will be allowed, but the penalty on GST then that is a separate expenditure. The
Right.
separate expenditure in the nature of penalty on GST that will be disallowed. GST payment because it is allowed on payment basis, whenever you pay, that will be allowed. But in because of there was a delay, in consequence of the delay, if there is any penalty which is imposed, then that penalty will be disallowed.
Okay, sir. And one thing I just wanted to understand whether I understood it properly or not. You were discussing about the insurance compensation, right, sir?
Yeah,
So here it is very very specific attack on the transfer definition, right?
definition true.
Am I clear? Like,
Yeah,
so
yeah.
if it because it is cessation of the right, not upon the asset. So period of holding is basically depending on the capital asset when it is in existence or not. Is
Existence
that
when
so,
you
sir?
are holding that as a capital asset. So you hold only the time when the asset was in your possession. After the destruction, you never held that asset, isn't it? That is a demise
Yes,
of
sir.
the asset. So after a
But
demise of
sir,
the asset, you
you
are holding it.
Hmm. You are right, sir. But no, but the definition itself of the capital asset is telling that it's a property which is basically dealing with the legal right, holding of the legal right. So I was being confused between that.
Yeah,
Did you?
legal right
Yeah,
in the asset. There is no, in this
correct.
case, the right that
Yeah.
is there is on account of the asset. Because of that, you are getting the insurance compensation. So the legal right that should be there is in respect of the asset. Supreme Court said that what should go away is the right, not the asset in for on which the right got originated. If the asset itself has been lost, in this case, on which the right itself has not is not been originated, so that you are stretching the concept to the definition of capital asset. Stick to the definition of transfer. Transfer, extinguishment of right. Any extinguishment of right is what is considered as a transfer. Right in what? Only the right has to extinguish, is what they have said. Meaning thereby, like for example, I am having this particular asset. So I am having this particular asset and I am selling it to you. Now, after sale, my right in that asset is gone. But the asset continues to remain in existence and this right goes to you. The right in that asset goes to you now. on the sale. But what if the asset itself has been destroyed on which the right emerged? Question was, therefore, can it be considered as a transfer because of which you are getting an insurance compensation? So the emphasis over here is on transfer, not of the capital asset. So therefore, focus on the emphasis on what? On the transfer. So therefore, the question was, once the asset on which the right existed, that asset itself was destroyed, in that context, the period of holding, because here you're talking about a specific capital asset. And what is the specific capital asset? The specific capital asset is that, say, whatever got destroyed. Okay, say plant and machinery. So plant and machinery is a specific capital asset, and because of that, if that is destroyed, you will say the period of holding will then be counted from the date of acquisition of plant and machinery till the date when the plant and machinery cease to exist. That would be the period of holding.
Yes, sir. That's why I was like, first thing, prima facie, it should be a capital asset. Then comes the transfer part, and
Right.
after the transfer part, then comes the all other scenarios. So I
Yes.
was linking it with the
So, but
definition of
the approach
capital.
is fine. Approach is good.
Yeah.
I know that
But
the depth in which now you are thinking, I
Ye-
appreciate that.
Yes, sir. And the one another, it's a very basic query, but sir, I'm being little confused.
That's
So
fine.
you said about the definition 2, clause 109. You are saying not as subsection, you are saying as clause. Why so?
Uh,
About the
clause and
definition.
this.
Yeah, that was,
Yeah,
I
that
was
is
like, why you
true.
talk?
But the technicalities that we can talk about it, but in the definition particular part versus a subsection. See, in this case, a subsection generally comes up with a scenario. Like for example, when we talk about, we can also say there is a this thing. I will have to then give you the Roman particular part and all. Na? So I think that will be much better. I will explain that thing in the next class. Will that be fine in this case? Because then I will not say like this because then I will have to write two, three Roman particular part. So not only this, then I have to compare two or three things. I'll let you know. But just keep this thing reserved for the next class.
No issues. So when I should remind you about this?
It
That's
will
what I
Tuesday
want.
towards the end. Then
Sure,
before
sir.
before I'm writing, because then I'll write those two, three things. Because then I'll do a comparison part of it. What is this clause and subclause and this other things and all.
Yes, sir, because under the basics also it was being like faculty was reading as the clause and not as the subsection. So I was like, what is happening over here? Earlier in the earlier income tax act, I never faced this. So that's why.
True, true, true.
So that was the issue which was coming. That nothing else, sir. So this is the questions which I had. Thank you, sir, for
Perfect,
solving.
perfect. Any other query, students, that you have apart from this? Gayatri, Kanaya, fine. Just ensure students on the Saturday particular part. On the Saturday, students, you will ensure to go through this because obviously Saturday we're not meeting. So please solve that question, number one. And two, students, the capital gains up till now, please revise and be ready. Whatever principles that we have learned today, please do ensure to revise them because on Tuesday, the next particular class, we will be starting with buyback, which is a big amendment that has happened by the Finance Act 2026. Okay, I have also drafted the case study for the same. We will be doing that thing. See you then, friends. Take care. Bye bye. Good night. And happy Independence Day to all of you. Yes, in advance. Yes, yeah. Bear Act, please do that. Okay. Bye. Take care. Take care. Bye. Bye. Thank you. Thank you. Same to you. बंद कर देते हैं. Okay.